We are live with Nik Bhatia in Sydney. Hello, man.
What's up, Pete? Good to see you, man.
Good to see you. I didn't think the next time we would record would be on the other side of the planet in Australia.
Well, I appreciate you having me as your West Coast representative here on this side of the world.
Well, listen, man, it's great to have you here. We love these live events, and we were like umming and ahhing the various people to get. We drew up a list, reached out to a couple, and you said yes, and we appreciate you coming in. Have you been here before? You been to Australia before?
I have. In 2016. I visited Melbourne, Sydney, and Cairns.
So you did it as a proper holiday then?
I did.
Yeah. Well, this is my first time, and I think it's very cool. It's Danny's shortest ever journey.
Yeah, love it.
For a recording sprint.
I'm feeling fresh.
What was it, an hour?
An hour in the plane, yeah.
An hour in the plane. How long was your flight?
15 hours.
15 hours. That's a long flight. Yeah. Mine was 2 flights, 23 hours. But look, great to see you, man. It's been, I've known you a long time now. About 5 years, 4 years? I can't even remember.
Since we last recorded?
No, since when I first met you. That time I rocked up in LA.
That was 2019. Yeah.
Time Value Money series.
That's right.
God, man, so much has happened. And congratulations on all your success. You're claiming to be a competitor now. You're not a competitor, you're a friend. But congratulations, man. It's been great to see.
Thank you. I am having a blast building the Bitcoin layer. We came to see you in Miami to talk about some of the work we're doing. We're very proud of the content that we're producing, both written, video, and trying to cover Bitcoin, the transition toward a more Bitcoin-centric monetary system. But you can't do that without covering rates and what's happening with the global economy. So we try to balance both of those things.
I think it's a good sweet spot for you and Joe.
Well, for me, I come from a background of trading interest rates. And so when I wake up in the morning, my day starts with the same sort of routine, looking at markets, reading the financial news, looking at the economic data. That's how I start my day every day. So that's how we approach the publication. We come with an interest rates mindset and framework, global macro framework as well. And then, oh, by the way, there's this thing called Bitcoin, which we do believe is going to be here for another 100 years. And if that's the case, there needs to be some explanation along the way why Bitcoin on a daily basis. And you know that I'm trying to do content that's why Bitcoin on a more decade to decade basis. And that comes with books.
Okay, let's get into there. Firstly, just interest rates. Why are interest rates the starting point for you?
So when I was studying finance as a college student, master's student, I had to basically decide. I knew I loved markets, right? I knew I loved following the global economy, geopolitics. What really was interesting to me as a young person studying economics for the first time in high school were foreign exchange relationships. Why does a currency strengthen or weaken versus another? And that really is global macro. And when you dive deeper into it, you understand that interest rate parity, or the differences in interest rates around the world, oftentimes is the main driver of currency relationships. So I got deeper into studying, and then basically the first couple job interviews, the people were asking me, questions. I was applying for equity research positions, fixed income positions. The people on the equity side, there were way more equity jobs available. They asked me, what is it that you want to do? And I said, I love global macro, foreign exchange, interest rates, the Fed. And they said, what are you doing in an equity research interview? You shouldn't be here. And actually, if you go equities, you'll never get to the rates world. And so at that point, I said, then this needs to be my focus. I went all in on the study of interest rates and ended up getting my first job in the industry at a fixed income hedge fund. And the rest, from that point, then I became, a member of the fixed income industry from the institutional side. So then I adopted the methods of rates professionals. And that just means starting your day with what is happening in interest rates and what are the drivers. That's really what it comes down to. Why rates go up or down is anybody's guess, but what drives it is what we can study and try to project, and then maybe you can understand a little bit why rates are going up or down.
And when you get up in the morning and you're having a look, what are the key signals you're looking for?
So I start always with prices. So what we're doing is looking at the way that interest rates or other asset classes move up and down through time. You're looking at prices. And I like the expression that technical analysis is horoscopes for men. I think that that's a funny way to describe it. But what I do is not technical analysis, meaning that I'm not looking at statistical patterns and trying to figure out the next trade. What I'm actually looking and I'm doing is what I call price study, which you're studying the time series of prices over a long time horizon. And through that picture, which is a chart, you don't even need any lines or indicators on it. All you need is the image. And with the image, you can see buyers and sellers are doing this. You can just see it. If a price is going up over a 10-year time horizon, what are buyers doing? They're overwhelming the sellers, and vice versa. So when I look at prices in the morning, interest rates up, down, stocks up, down, I'm looking at it, of course, today, but then I'm zooming out to what has it done this week? What has it done this month? And what are the prices telling us about supply and demand in these specific markets? And through that, I extract information about the global economy, what's happening, the demand for liquidity, the demand for risk, and the demand for safety. All of these factors are in play at all moments when financial markets are open. So when I get up in the morning, I'm looking at prices. That's the first place I look to see, is there any immediate information that I can extract if something is up a lot or down a lot? Then I will go to the news and I will read maybe what caused some of those movements. And then I'll turn my attention to the economic data set. So that comes out, in the morning, in the first few hours in the morning. And I'm able to take each one of those data points and determine that this is important, this is not, filter it in, and then add it to the framework.
And how important is the actual rate itself versus the movement in rates?
It's a good question. The absolute level of rates is definitely important, right? Because if you think just from a basic corporate finance perspective, if you have a $100 million note, it's floating rate. Your rate is 2% a few years ago. Your annual interest rate expense there is $2 million, right? So you know that on a monthly basis, you're going to need about $200,000 going towards this debt payment. And if you're bringing in $400,000 a month, you have a positive margin. But if rates go to 6% on that loan, now you have $6 million a year divided by 12, that's 500,000. So you have $500,000 in interest rate expense, but I just told you that your revenue was 400. So the level of rates does matter a lot. But, so does the direction and the movement itself. But when I think about today and interest rates being at 5 to 8% for basically most of the borrowing economy, right? The government's borrowing at about 4 to 5%. The private sector somewhere in 5 to 8% in the investment grade or the good credit realm. That's expensive relative to the last 15 years.
Relative to the last 15 years, but is it more healthy to have, I don't know how to put it, like a decent cost of capital? Because we know 0% interest rates have kind of like skewy effects. So is it more like it's a tough adjustment going up to these rates, but it's good? Because I remember as a kid, you used to get the TV adverts, Yorkshire Banks, savings account with us, 7-8% interest. And my dad knew if he wanted to borrow money, it was expensive. But if he wanted to save, there was a good incentive. There were good interest rates. We got to a place where I remember like Revolut. I was told my interest rate in my savings account was going up to 0.25%. Like absolute garbage. No incentive to save when the interest rate is so low and inflation is so high. So are we adjusting back to a more healthy place?
So instead of arguing healthy versus
Yeah.
unhealthy in the absolute level of interest rates, think of it as a lagging indicator to current situations. So what's the current situation? High inflation relative to the last 40 years, right? So we're in a high inflation environment right now. And in a high inflation environment, those with capital are going to demand more money to deploy that capital in the form of higher interest rates. So it's actually a market lagging indicator to the current dynamics that we face in the global economy, which is predominantly inflation right now. And so instead of thinking that, yes, it's healthy, and I would argue that, yes, generally a 5% cost of capital is more healthy than zero, because a 0% cost of capital will give rise to silly and nonsensical investments, right? Because the annual interest expense is nil or effectively nil. So if you don't have any profit, there's no punishment for it, right? But now with interest rates at 5 to 8%, if you don't clear the profit, you're going to either be going bankrupt, you're not going to get your loan rolled, and you're not going to be, able to fund your projects which generate the cash flow in the first place. So yes, I would argue that 5% is better than zero in that it prevents some malinvestment. But it's actually just a function of higher inflation, that you have to demand more interest from borrowers if you are a lender. And in that way, you effectively are slowing down investment and increasing savings, or the propensity to save, with that type of activity.
Okay, so which parts of the economy are the interest rates set by the market, by the private sector, and which are set by the central banks? Because central banks set rates.
Yeah.
But what you've just said to me there is something that I've never even crossed my mind. It's like, yeah, if I'm going to deploy capital and inflation's at 8%, well, I kind of want 10%.
Right.
Yeah, it just hadn't crossed my mind that I as a deployer of capital would want to do that.
Yeah.
For me, I just always thought interest rates were set by the central bank,
Sure.
and everything rolled on from that.
So, maybe Danny can pull it up if he can find a chart from one of the recent Bitcoin layers. I can't, point to any one specifically, but if we've published charts, the 2-year yield, Treasury 2-year yield versus Fed funds, and we overlay them. And this is a chart we've been tracking basically since we started the Bitcoin layer in 2021. What we show you is that rates lead the Fed. The Fed is simply lagging. So when the Fed increases interest rates from 0 to 5%, if you look at it on a chart, it's simply 3 to 6 to 12-month lag of the 2-year Treasury yield that was sold, meaning the bonds were sold, yields went up, right? When bond prices go down, yields go up. So those that owned 2-year treasuries yielding 1% looked at either their grocery bill or the CPI data. Doesn't matter, right? You understand that it doesn't matter if they looked at CPI or they looked at their grocery bill or they looked at their rent. It was going up. So they said, I got this instrument paying me 1% is not going to cover my increase in prices for the next 2 years, because I see that as 5% in the market. So I'm going to sell this instrument. And the selling of each person, each investor that sells their 2-year note at 1%, then it goes to 1.5, then 2, then 2.5. Who is stepping in to buy the 2-year note at 2.5%, a year and a half ago? The answer is basically nobody, because the yield went to 5%. And when did the Fed get to 2.5% or 5%? If you look at the chart, it's months after the market had already gotten there. So yes, the central banks set their policy rate, but it is basically a lagging indicator to where the market puts them. And that is something that we can empirically prove, and we have with, the visuals of interest rates versus, market interest rates versus central bank policy rates.
Okay, so when central banks set their rates and claim like they're hiking because they want to reduce inflation, it's kind of sold as like strategically the same. We're raising rates. We've got to get inflation under control. But really, is the market preempting them and seeing the inflation? And if there was no central bank, you would still have these interest rates and cost of capital, which would ultimately lead to reduction in inflation. So are they a passive player in this?
They're a passive player. They're a lagging player. But the answer actually goes to the very technicals of interest rate math and bond math. I'll try to break it down as simple as I can. A 2-year treasury security called 2-year note. A 2-year note mathematically should equal, the return that you get on that 2-year note should equal what the market expects you to get on a 1-day instrument for 2 years. So, if you think about 250 business days a year, so 500 times compounding an overnight rate is what should equal the 2-year yield. Now, do we know the 2-year yield today? Yes, it's on the screen. That's the price. Do we know the overnight rate for the next 500 business days? No. Because the overnight rate for the next 500 business days depends on who? The Fed, right? Because the Fed sets the overnight rate. The Fed sets the policy rate. So when the Fed says we're raising rates 25 basis points, they're not actually raising the Fed funds rate by 25 basis points. They're raising the window of money market rates, the floor by 25, the ceiling by 25, and they're moving what they want the overnight rate to be out in the market. Overnight repo for Treasury, which is collateralized borrowing. Federal funds, which is the market for one bank in America lending to another bank in America for the reserve account that they hold at the Fed. Okay. Also, adjacent to this, not necessarily directly related, but the rate at which London banks lend to each other, which the artist formerly known as LIBOR. All of these rates are in the target of what the Fed is doing. So they raise the target rate, they lower the target rate. That's what they do. So the 2-year yield is an expectation of what the Fed is going to do for the next 500 business days. So when the 2-year yield goes up, what the 2-year yield is saying is that, hey, we've read between the lines. Either the Fed has explicitly said it, or the economic data just shows us what they're going to do. In early 2021, in mid 2021, when inflation was starting to pick up, the yield of the 2-year yield was still like close to zero. It was basically nothing. Then at the end of 2021, inflation started to go. So did the 2-year yield. The Fed was still saying transitory. But investors knew better, right? So investors knew they're going to hike. Sell, 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 sell. And what happened? The 2-year yield started to rise. And it rose, 4 or 6 months before the first hike in March of 2022. So the yield is just the word we use is discounting, but it's basically just an average of what they expect that overnight rate to be. Because if you're an investor, institutional investor with no appetite for risk and $1 billion, what are you going to do with that $1 billion? There's only a few options if you're not willing to take any market risk, or what we think about as risk, like stocks or corporate bonds. You have a few options. You can park it at a money market fund, which owns treasury bills. You can own the treasury bills themselves, or you can go out to a 2-year note and buy that and lock in whatever yield that is. So the institutional investors coming to the market and saying, hey, we can either invest overnight 500 times or buy this instrument once and not do anything for 2 years. And they have to make that decision every single minute of the day. You understand? It's not like a one-time decision. It's a continuous market decision. And so in 2021, at the end of 2021, those investors says, hell no, I'm not going to roll my, I'm not going to lock in my 2-year yield at 0.5%. I'm going to go to overnight because they're going to start raising it. And guess what? When they raise the rate 25 basis points, or they raise the window 25 basis points, and you're that investor that didn't buy the 2-year note, you're just rolling every night. Guess what? Tomorrow night, you get 25 basis points more, right? Divided by 360 because it's just one night. But still, the annualized yield that you're getting is 25 basis points more than it was. But if you owned the 2-year note, you're losing money every day as the rate goes up because you locked in 0.5%. So your investment is worth less and less and less each passing day, as it's obvious to everyone and their mother, inflation is here. It's not going away anytime soon. Fed is clearly going to have to raise rates a lot and keep them higher for longer, which is what's happening right now. When June, July of 2022 passed, that would be about a year plus ago now. Inflation hit 9.1% CPI on the reading and then started to go down pretty sharply. By October, we had seen 4 or 5 months of consecutive declines in the inflation readings. And I believed at that point, hey, CPI is coming down sharp enough. The Fed can slow down its aggressive, hawkish rhetoric, meaning the Fed doesn't have to say, we're going to be relentless in our rate hikes. They can ease up a little bit because inflation is clearly coming down. And it has. It's down to 3%, right? So it's come down a lot. But the Fed is not willing to do that. And I was definitely too early or wrong about how quickly I thought that the Fed would level off their interest rate increases, or at least their hawkish rhetoric.
So why do you think they're doing that? Could they overshoot the other way?
Yes, and they will. I mean, and I absolutely believe that they will.
What, and go deflationary?
So right now, we are in late cycle, right? So the business cycles. And when you're in late cycle, you're in the time when the Fed is raising rates or has raised rates a lot. And then that starts to feed into the economy, right? So from a general cycle theory, we'll go from a tightening cycle into a recession, right? Generally speaking, that's what an inverted yield curve often signals about 2 years in advance. So we had that signal last year. So we should be, getting a recession sometime soon in the next year. I don't think that would surprise anybody, right? It wouldn't even surprise the Fed. The Fed has admitted this year that we believe a recession is probably coming sometime next year. They said that mid-year. They've eased off that a little bit, but they are fully aware of all the lagged effects of their tightening and what that can do and how it can cause a recession. The reason that they are going too far right now, I believe, is deeply rooted in some vanity issues and some ego issues that stem from, this is at an institutional level, the transitory word that they used, but also from the QE infinity that they've basically employed since 2009. They have to show that they have the other side. They're hawks and they're doves. So they went dove, then they went dove, then they went dove. So does it make sense that we might get 15 years of too much hawkishness as effort to repair the reputation of the institution? Maybe, yes.
We shouldn't have place for egos in these decisions.
I agree with you, but there's no reason. I mean, I believe that there's very little reason to have kept hiking after March. We have Silicon Valley, go under. We had Credit Suisse. We started to see bank lending seize up. Then we had another regional banking crisis in May where a couple banks went under. And there's so many signs that you don't have to go further, or you don't have to keep going this far. You can say we're stuck here, but they can't give that signal to the market too early, because what is the market going to do? They're going to price the cuts in. They're going to start buying all the fixed income instruments and driving them down, like we talked about, and then actually force the Fed's hand to start cutting rates. So it's all a mind game.
Yeah, so I was about to say, it sounds like a game.
It's incredibly psychological what the Fed does. Jeff Snyder talks a lot about this. It is so psychological what they're doing. It's all behavioral economics. They write about this all the time. The wealth effect is a behavioral premise. Everything in the economics field of study really is a lot of behavioral, hey, this is how we can influence behavior. So it is in the science and of what they do. And that's just what they do.
But it's a game. It's like a game of chess between the Fed, which is a small group of people, and the market, which is a large group of people.
I honestly don't think the Fed makes that. The market always leads. So right now, why isn't the market pricing in extreme cuts to the point where the Fed is forced to cut? Right, the market still has cuts and has had cuts in a 6 to 12 month forward looking basis since Silicon Valley.
Yeah.
Right. So cuts were priced into the market as of March. The initial drawdown actually said by September we'll be cutting in March. So in 6 months we'll be cutting. That was wrong, right? Because they're not cutting yet. That's not where we are. So the market has priced in those cuts, but why hasn't the extreme happened? Because the US is not in recession. The economy grew in Q1. It grew in Q2. It's going to grow again in Q3.
So it needs the recession to drive it.
It needs the recession to actually get the cuts. Where's unemployment? 3.9%. It's up a little bit, but it's still low. Where is ISM services?
So what is it you would see? This is the 10-year Treasury.
Yeah.
Where is it you'd see them pricing in a cut? Is that this drop?
So the 10-year yield is not the best.
Okay, what's better?
The 2-year, but you can keep it here for a second. You see the drawdown from March to April in the yield?
Yep.
That is investors seeking the safety of long-term treasuries yielding 4% and buying all the way down to 3.5%. That is a flight to safety. That move that you see from March to April, 4% to 3%, it went to 3 1/3, I believe.
So that's because they think that long-term treasuries will likely drop. So get them while they're good.
Get them while they're good. Get them at 4.
So here's the 2-year.
Yeah, you see that drop from March to it went actually from a 5 handle to a 3 handle. Yeah. So it moved 120 basis points, if my memory serves me correctly, from top to bottom in March in one swift move. Mm-hmm. And I always tell Joe, rates reprice super fast because the market picks up on the shift really, really fast, especially in the treasury part of the curve. And look, they were bought and then a slow sell-off as, oh, wait, it's not a crisis. It's not a recession either.
So now we're back at nearly 5.
Yeah.
So the market's basically saying, okay, nothing's going to change for now.
Yeah, because where's the policy rate? 5.25. So the market is saying, hey, we actually think the policy rate's going to stay around here.
Recession is an interesting word because if you don't understand financial markets, you don't have a podcast where you get to speak to Nik Bhatia and have it explained to you. If it's something you're just aware of, you see as news headlines, you hear your parents talk about it when you're growing up, you think of it as this thing that's an absolute disaster. We're going into a recession. Everyone's going to be struggling. Life's going to be terrible. But really, recession to me now is just a period of market correction. And it's a necessary part of a market correction, of a market cycle. Is that right?
So I would argue that, let's just say the stock market, to be more specific in this realm, the stock market is a lagging indicator to what is actually happening in the economy, specifically with corporate profits, right? Because that's what drives in part, share prices. Share prices are driven by two things: earnings and valuation. So earnings is how much money they're making and clearing, and valuation is how expensive are those earnings. So that's the psychological or behavioral aspect to markets, right? We know what they earn, but there's always a multiple to that earning. When recessions happen, stocks go down. Absolutely. That is empirical. But why do stocks go down? Because the companies are selling less and therefore making less money. So earnings are declining. So stocks go down because earnings decline. Earnings decline because in a recession, consumers stop purchasing or slow down their purchasing. So it is economic in nature, and the stock market is a symptom of slowing sales. And when a stock investor looks at, the channel checks or the same store sales, and they hop on earnings calls, the companies are the first ones to say, hey, like Intel, we're selling less chips. Then you start to see, okay, we're going into a recession because the companies are starting to sell it. The recession is simply the diagnosis that sales have slowed. And why do sales slow in a recession? Because an economy cycles, right? Yeah. Interest rates go down, investment goes up, then inflation goes up, interest rates rise, profit margins decline, and people get fired, and then they stop buying things, and then profits decline, and then interest rates decline because inflation is gone, and it cycles.
Yeah.
And so when you talk about recession means a drawdown in stocks, that's correct, but that's not the only thing happening there, right? There's a chain of events that is cycle-based, and it starts basically with profit margins going down.
I think what I'm getting at is, I think the word recession was a scary word when I was growing up. As a young man, like in my late teens, early 20s, and now it's less of a scary term. I think of it more as just an indicator of where the market cycle is. But it's treated in the news like panic. We're going into recession. And it just feels like it's, you've just explained the market cycle. It's just part of a cycle. We will go into a recession and we will come out of a recession. Is that fair?
Yes.
Yeah.
And I would also add that we actually haven't seen a recession since 2009.
Yeah, why?
Because the
should
COVID
we have?
Yes. The COVID recession was coming. If you look at like where the market was, we were going into rate cuts. That had already been priced in before the pandemic.
We were talking to, like, Travis Kling was talking about this before COVID. This was like the repo crisis, right?
That's right. That was September 2019. And the Fed had to pivot policy and start basically easing.
What, Danny? Can you explain the repo to me? Can you explain the repo?
Well, Nick's here.
No. Explain. What is reverse repo, Danny?
I'll defer to you here, Nick.
Every time it comes up, we could never explain what it is again. Lynn Alden has explained it to us 170,000 times.
Pete, I'm going to try.
Do it in a way so we never forget.
The pawn shop for bonds is the repo market. It's a pawn shop for bonds. Okay?
People need to get rid of them quick.
What do you do with gold jewelry when you go to a pawn shop? You give them the jewelry. They give you some cash.
Yeah.
But the jewelry is still yours as long as you pay back the loan.
Yeah.
That's the repo market. Except instead of a gold jewelry, it's a treasury bond.
That is brilliant. I'm never going to forget that now.
Yeah, right.
It's a pawn shop for bonds.
And what's the duration on those usually? Is it when they say overnight repo, it's overnight?
Overnight.
All right. So I need some capital. Take my bonds. I'll come back and get them tomorrow.
That's right.
Okay. And you pay like a little amount on it.
Yeah. Whatever Fed funds that window that we talk about right now, around 5.25%, that's going to translate to the overnight repo rate just because of how money markets work.
And the repo crisis was there was just too much. There were too many people with gold jewelry and not enough cash behind the till.
There were a couple market players because of a certain type of trading strategy that had gone wrong.
Okay.
There were a couple market players that were unable to find a pawn shop that was open.
Right. Okay. And so, had you expected us to be in recession right now? Are we in recession in Europe?
Oh, yes. Europe, Germany is in recession. The Eurozone is in recession.
Is
France
UK?
is
Is the UK in?
The UK just went into recession.
When was that announced? Because I've not even heard it.
That was in the last month or so.
Okay.
And Germany's been in recession for most of the year, to be honest now.
Do all markets classify recessions the same? Like is it 2 quarters of negative GDP growth?
That's the general accepted term.
Yeah.
And when you look at economic activity in Germany, it is so I don't use GDP in my
Okay.
framework, right? At the Bitcoin layer, we use PMIs, which are the surveys of companies in these countries that are hiring people and that have input prices and things of that nature. So we look at PMIs, and in Europe, the PMIs are all in contractionary. Danny can even pull up a global PMI tracker on Bloomberg, and it's a map, and it visualizes. You can just see Europe. The whole continent is red. It actually has the United States in negative territory at the moment because using this survey, the US PMI is below 50 using this particular survey.
So so it's deteriorating. Okay, so the measure on this map is the trajectory, not the position, because it says deteriorating and improving.
No, deteriorating and improving.
But could you be in recession but improving and therefore be green even though you're in recession?
The metric of PMI measures whether the economy is deteriorating or improving. But the color that you see is the status of each one of those countries, not like it's in the number.
Okay.
Right? The number, if it's below 50, it means the economy is deteriorating.
So in this
month over month. And that's the key, Pete. It's a month over month change. So the lower the number is, it means the worse that this month was to last month.
So this chart is indicating to us that the UK and Central Europe is deteriorating.
You can see Taiwan in recession. You can see India's the strong point
India's
in the
crushing.
global economy. And again, the US is not in recession. It just so happens that the PMI of using the S&P PMI here is showing a little bit below 50. So the US economy is struggling by some metrics, but the US GDP is still positive. In Europe, the GDP is actually negative and confirming the PMIs that it's in recession.
Okay, so Europe is pretty fucked. And America's indicating it's heading that way.
Right, but Europe is a symptom of the global economy. This is what needs to be understood. It is the economy is global.
Yeah.
So when Europe is in recession, it means the world is not buying their shit. It's the global economy that sends Europe into recession.
Yeah.
It's nothing to do with Europe. Europe makes things that everyone wants.
Yeah. It's funny how small Europe really is. I mean, if you don't include Russia. A tiny little pathetic continent.
You like that, those the memes where they fit all the countries into Texas?
Yeah.
I love that.
Well, Australia is about the same size as the United States.
Large country.
I think the UK fits in something like Idaho.
It fits into just Queensland like 4.
I feel like this they've overstated the size of the UK here. I think we're smaller. It's smaller and more pathetic than that.
It's pixelated quite large.
Yeah. And the recession we're in Europe, how deep a recession is this? How deep is it expected to go? What do we know about it?
Right now, it's not that deep. Okay. And how deep is it expected to go? That's what I love about the Bitcoin layer. We're not a trading service. We're not even trying to project the economy going 12 months forward. Just trying to analyze the fixed income markets to give people some signal to what is happening. Because people that try to project too much, you're just making shit up. I mean, it's
horoscopes for men.
It's who is to say what's going to happen? Where is the European economy right now? It's in recession. It is not looking good in Germany. I'm going to tell you that. I looked at some of the year-over-year numbers in Germany in terms of some of their exports. If Danny can just look for
And why is that?
global demand.
Okay, but global demand specifically
Chinese
for German
demand.
products.
Chinese demand for German products. I mean, if you want to be very specific about it.
Which is cars.
Right.
Yeah.
And I was reading about how
I wonder
China is really going internal with their car purchases. They're favoring Chinese brands over German brands. So that might not be that, the global economy is crashing. It might be something more specific to Chinese consumer patterns.
And could it also be a shift in the types of cars people want? Could Germany be behind on electric vehicles compared to Tesla?
They're not.
Other markets? They're not.
They're not behind.
Okay.
They're a leader. Volkswagen, is a global leader in the technology. So is Mercedes.
But is there a demand for those cars? Because if I was going to buy an electric car, my starting point would be Tesla. I wouldn't be thinking I'll get an electric Volkswagen.
But in China, they're making domestic EV purchases.
Right. Okay.
And in Europe, they're buying Volkswagen EV products. I mean, for sure. So, but it's not just cars, right? It's not just. But my point is that yes, it could be a little bit of this pattern that Chinese consumers are going to Chinese EVs over German vehicles, but it's probably not. It's probably systemic. Global demand for German manufacturing, whether it's cars, medical equipment. Germany makes a lot of stuff, right? Siemens is one of the largest. There are just so many important products that come out. Yeah, BYD is absolutely crushing it.
Who the fuck is BYD?
It stands for Build Your Dreams, and it's a very popular car.
How have I not heard of it? And
I've
it's
not heard of it
the
either.
largest electric car maker in the world. I mean, they're selling what, 20%, 25% more than Tesla.
I don't know what BEV and PHEV means.
It's funny because Tesla has less of the market than I thought they had. So everybody else has been catching up pretty well.
Maybe it's something to do with being like full electric because Tesla's fully green.
Okay. Yeah,
and
no,
these
you're
could
probably
be like
right.
sort of
Hybrid.
Yeah.
Hybrid electric vehicle. Blatant electric vehicle. Okay. That's interesting. And
Yeah, so this confirms what I was telling you about, Chinese demand for German cars, but I cannot, look at the map.
Yeah.
And look at the UK in recession. Has nothing to do with this. It's a global recession.
Yeah.
And it's slow moving. The interest rate, your first question was, does the level of interest rate matter or just the direction? The level matters a lot right now.
So what is the Bitcoin layer to all of this? Like when you think of all of this, you look at what is Bitcoin's role? What's its position in all of this?
When we put it in the context of the global economy cycling into recession, where Bitcoin stands or where it comes into play is that when you cycle into the easing part, policymakers are able to demonstrate just how diluted the currency can be. And that flood of capital liquidity, the flood of liquidity that comes from policymakers, either fiscal, monetary, or both. It was both. In the great financial crisis, it was both, but largely monetary only. That it shows you an apolitical, policymaker-free currency algorithm has value. And so when you see Bitcoin rise, and this is, everyone wants to talk about, does the halving matter or not? And then actually Bitcoin's rallies have lined up with global easing and has nothing to do with the halving. I don't want to come down on either side there, but the truth is that Bitcoin performs really well when central banks go into easing mode. And we don't have...
There was a good chart on Twitter this week. Somebody said everyone thinks the halvings drive price, but he'd layered on the periods of currency expansion, and they actually just seem to line up with the halvings.
Yeah, we do a global liquidity versus Bitcoin price graph as well on the Bitcoin layer. It is basically an overlay of the major central banks.
And do you feel like we are in the next 6 to 8 months potentially heading into another period of?
What did we just talk about earlier? That they
Yeah.
could be heading for 15 years of hawkishness. And I'm not saying that's my base case, but you have to think what might happen, what could happen. Bitcoin might not be able to extract value from central bank easing for the next couple years. Now, what is my base case? They'll be easing next year.
Okay, there you go.
Because we're heading into a recession.
During the halving.
Yeah, during the halving again.
So what is this? What is it? Has Satoshi lined up the 4-year halving cycle with business cycles?
The correct question is the global economy falling onto the Bitcoin calendar and block time?
There you go. What do you think?
I mean, I think it's at the moment fantastical and even far-fetched, but very cool to consider that in maybe 12 years, we could have a definitive answer. That would be really amazing. And I'm patient.
Yeah.
I'm patient to wait to see if that's actually a thing. But no, I can't go out on a limb and say that right now.
Okay. Talk to me more specifically about China. And the reason I have an interesting what's happening in China is more because of the conversation regarding BRICS keeps coming up. You know, what will they do? You know, will they come up with their own currency? Will people increasingly start settling in the yuan? But people I trust and respect keep coming back to like, yeah, maybe they want to push for this, but realistically, you really want to settle in the dollar. It is still the most trusted reserve currency globally. Don't expect massive settlements in the yuan just yet. If the Chinese economy is in trouble, the yuan could be in trouble. Therefore, that kind of puts a kibosh in that.
Yeah, I think you have it absolutely correct.
Completed it.
Right. Okay.
Yeah.
Thanks, Nick.
So let me ask you then. No.
Yeah, go on.
I think you've summarized that perfectly.
Yeah.
And take it one step further.
Yeah.
What type of BRICS block currency would we ever see? It's so, you want to talk about far-fetched?
I mean, the only one I think is a gold-backed currency.
That itself is very far-fetched. Any BRICS united currency, whether gold-backed or not, it is not even in the realm. By the way, in their recent summit held in South Africa, they removed or didn't include any united currency. It's not even part of their communique or their list of topics that they discussed. Okay, so that whole thing is imaginary. The BRICS currency is imaginary. Going to the Chinese yuan as a settlement.
Sorry, just before that.
Yeah.
So is BRICS really more just a economic union? Is it like another G7 really?
Do you know that Xi Jinping is not going to New Delhi for the next G20 meeting?
No, I did not
Yeah.
know that. Okay.
He's not even going to India.
Because
China and India aren't allies.
I know.
You know, they're not allies. And the BRICS, you're right. The BRICS is basically...
Is it
hey,
like
let's
the rogue,
trade,
is it the rogue
trade,
G7?
Yeah, it's let's trade more with each other.
Yeah.
And that I'm not going to deny that that's happening. And let's even use our own currencies in cross-border settlement. Sure, that'll happen too. And it's been happening. And I'm not denying any of that. But they're not really a bloc. They're not united in any effort to dethrone the dollar. That's kind of the thing. If they were united in an effort to dethrone the dollar, they would actually come together and start a currency and actually try to challenge it with a bond market and financial plumbing and a repo market. You understand none of that stuff it's imaginary for a BRICS united currency, doesn't really exist in any internationalized sense for the Chinese yuan whatsoever. The Chinese yuan isn't a convertible currency around the world either. So there's just nothing. It's a bunch of nothing.
Bunch of signal.
On the currency front. But on a geopolitical and a trading front, there's no denying that we are in a multipolar world. It just doesn't apply to the monetary system.
Okay.
And more importantly, I don't think that it will apply to the monetary system in the coming years, right? I always caution against making, projections too far out, but there's nothing that shows us that, oh yeah, in 5 years we'll have a BRICS currency. No, I would fade that I would fade that argument.
Okay. So back to China.
Yeah. China is really struggling in their economy right now. But my focus is that data out of China is harder to get or harder to assess what's going on there.
Because they don't want to tell us?
Yeah, exactly.
Because they're fucked.
So the best thing that we have, and this is my approach to it, is the price of the currency, right? So we look at the Chinese yuan versus the dollar as the number one signal to what's happening in China.
But the dollar itself has been performing well, right? It's like 7 consecutive months of growth.
Versus the Chinese yuan, or on like a global currency?
I think on a global basis.
So
I think it was 7. I think that's all Dylan and Claire post, 7 consecutive months of growth.
So I don't know if it's gone up for 7 straight months. The dollar has had a nice rise recently, and it is rising against all currencies, and we can go down that rabbit hole as well. But
stick with the Chinese yuan.
Yeah, but in the specifics of the Chinese yuan, when the Chinese yuan is weakening, it means that the Chinese government policymakers are guiding the currency to a point that allows them to access the market. So when they cheapen their currency, it makes their exports cheaper, right? We were talking about how in the Xi Jinping era, he has tried to say that we are going to consumerize the Chinese economy. We are going to try to shift from export-driven to more domestic consumption-based. And in that way, we will be more self-sufficient and less reliant on the global economy cycle and demand for our widgets and manufacturing sector.
How has he tried to make it a more consumer economy? How do you actually do that? What steps do you take?
Freedom.
He's definitely not tried that one.
No. That looks like it's lost 10% this year, which in a currency terms is massive, right?
Yeah. So there are government programs to try to incentivize consumerism. And in that way, they are making the policy effort, right? But what we know from the past few years is that the Chinese consumer is behaviorally just different than a Western one. And it's actually almost nothing to do with China itself. This is something you find in emerging markets. Countries with weak currency regimes historically, or unstable governments. Is that why would you spend money on stuff when you can hoard savings for a rainy day? And that is, I'm not an expert on, Chinese consumer behavior.
So this is cultural.
But my understanding is that shift is not happening in China, right? I would recommend Bill Bishop. So he does a great Substack. He's one of my main sources on China. Jacob Shapiro is another geopolitical analyst that I follow. So I'm reading people that are following, and also Michael Pettis. People know him. He's one of the more famous financial journalists that's stationed in China and gives fantastic information. So I'm reading all of this stuff, and my understanding is that shift isn't happening. So China has to fall back on what? Exports. And, the global economy is weak, so exports are weak, so they say we have to make it cheaper. And so when you see this number go up, that's dollar strength. The dollar strength is one weakness. The one weakness is, again, a symptom of global demand. That's the common theme here. The symptom of global demand is the Chinese has to weaken their currency. And if you zoom way out, it looks it looks really bad.
So where does
Can you zoom right out, Danny?
Yeah,
So we
yeah.
just see it.
Where does the housing crisis fit into this? And like, because I know Evergrande's blown up.
So the property sector in China has experienced overinvestment, right? So there are defaults looming everywhere you look. Now, the policy responses in China have been basically, let's come up with programs that don't force people to write down these investments, right? Either the banks or that defaults trigger write downs. That way we paper over the losses in the property sector. So China can do a lot of things on the policy side. What we know, overinvestment. What else do we know? Defaults are looming. What we don't know is how large the bazooka is in terms of stimulus or bailouts or extend and pretend measures that basically give the sector time to, absorb the losses. So one of the things that we're asking ourselves right now about China is the important question, hey, what will the property sector defaults do to the global financial system? Like, what impact will that have? I actually think that's the wrong question. The correct question is this weakening a symptom of a terrible global economy? And if that's the case, that's going to matter way more than whatever localized property bubble is in China, which on the grand scheme of things, on the global economy, I don't think it matters. I don't think it moves the needle. This is the more important thing.
What do you think is? Do you think this is all a symptom of a terrible global economy?
Yes.
Okay, great. How bad?
So if you look up Chinese exports as well, it does look like it's very bad. What is my worry here is if you combine 1 + 1 here, one meaning where are Chinese down 8% year over year. The nominal amount is maybe not the best, but if you read the top line here, it's down 8.8% year over year. It was down 14.5% year over year in July.
But please, go back to that 5-year though, Danny.
Yeah.
So we're not far off where we were, and like we're still above 2020.
So this definitely has a seasonal pattern here. But Pete, what the point is here that it's not just the numbers that are already red in China and Germany, like that are two massive red flags. The euro is in a mini crash formation. I wouldn't call it in full crash formation yet, but the euro is in a mini crash formation right now, adding to dollar strength. The yuan is also in a crash formation, adding to dollar strength. It's that plus the lagged effects of higher rates, right? Which are a lagged effect to the inflation, right? People demand more money for their money. And so higher interest rates are going to filter into reduced profit margins, people getting fired, those people not spending, that contracting corporate earnings, then stocks going down affecting behavior of US consumer because of the wealth effect. We know when stocks go down, US consumers stop spending. None of that has happened yet. That's why I'm worried, because it's already not great, even though the US economy is above water.
And do you think this could be a worse situation than 2008 we're heading towards, or?
Yeah, I'm not making that sort of call.
Okay.
I don't.
But is this why you think there may be a liquidity event next year because of this situation?
Liquidity events drive the Fed to do instant easing.
Yeah.
And that has not been my base case really since the hiking cycle began. I really remember that when the Fed started hiking, the going narrative, and even Arthur Hayes wrote a piece, he said, by summer, the Fed is going to pivot as after everything crashes. That was 2022. And I remember writing that, hey, a couple percent rate hikes is not going to crash the stock market. And I still feel that is my base case scenario, that stocks are not, and we're not heading for some grand liquidity event. That's just my base case. Of course, it has to. In the fixed income world, they teach you have to do your probability distributions. So I think 25% probability that we're going to have a liquidity event, 50%, and then 75% that we're not, and we're just going to be in a run-of-the-mill recession. And that is probably where I am, right? 25%. And so you adjust your language, your use of adverbs when you're writing, and how confident or not confident you are about what's happening. And you just adjust your approach. And for investors as well, because that's the background I come from, you're a fiduciary. You have to actually express your probability distribution. Hey, I 1/4 chance that we're going to have a grand liquidity event, 75% that we're going to have a general recession. And for this reason, we're going to go long treasuries and XYZ part of the curve. And this is how we're expressing that probability. So I feel blessed that I don't have to sit in that chair anymore, because it's a very stressful job, to be honest with you. I commend fiduciaries left and right. I mean, it's tough to have other people's money on the line. And I don't know what that's like for VCs. You have a lot of VCs on, but I know what it's like in a rates chair or fixed income chair. And that's big. It's big money. The clients that I had on my sheet were, top 10 companies in the NASDAQ, and, top 10 emerging market, like the entire sovereign wealth fund. Big money that they have. And when they have the money on the line, you have the money on the line for them. It is very stressful.
So how are you preparing?
For me, I'm focusing on my career. I mean,
just build resilient business.
That's right.
Yeah.
Because I'm not in that seat anymore. I have my own business, the Bitcoin Layer. I hope people read and watch and listen.
And subscribe.
And I'm writing my second book, because I know that books can have real lasting power. And on a daily and weekly basis, I'm giving my intellectual capacity to the Bitcoin Layer. And on an annual basis, I'm giving my intellectual capacity to write books.
Yeah, let's talk about this book, because you told us a little bit about it. Your last book, Bitcoin Layer, fantastic. Did very well. I know it's very popular. But you're going to sit down again and write another book. What can you tell us?
The book is about Bitcoin, and it is another story about Bitcoin. So with Layered Money, I tried to tell a story about money that explained why Bitcoin is basically a bearer asset. It's not much fancier than that, right? You guys know, if you read the book, what I'm basically trying to explain is that, hey, Bitcoin is not a liability of a financial institution. And liabilities of financial institutions are basically infinite in their theoretical limit, and have approached levels that make people uncomfortable to hold them, right? Nobody holds bank deposits as a long-term instrument. And why don't you do it? Behaviorally, it's unsound, right? And so I wanted to tell a very detailed history of why banking liabilities and Bitcoin are, qualitatively opposite from each other, and taking offense to people comparing Bitcoin to PayPal as well. So Layered Money addresses that. But if you step back and you really want to explain Bitcoin to the world, I feel like I have much more to say. There is a deeper history, societal impact, and promise within Bitcoin that you feel in your soul. I feel it in mine. And a lot of our, friends and colleagues in this industry feel when we meet with each other and we talk to each other over the years. We know that we all feel this. I believe that I can articulate it in a way that hasn't been done, in a very broad, human, and contextualized way. And I'm in my quest right now to tell that story. And I'm deep in the research. I've started writing the book. I do have the title. For self-publishing reasons, I can't actually share it in advance, just the way that it works when you're publishing your own book, because I can't possibly protect it until it comes out. But I promise you that it is a Bitcoin book, and it really has me fired up, dude.
Well, I look forward to that. Just finally, before we close out, you've done a lot of work studying global markets. You understand global markets very well. It's like a real pleasure to sit with you. You explain things amazingly well. You are a Bitcoiner, a proponent of Bitcoin. I'd be really interested to know what is the purpose of Bitcoin in the world as we are, and if Bitcoin fulfills its potential, what will it offer us? Nice big question to finish on.
Yes, and I think this is where you can let your imagination go, and you can imagine a world in which people actually have more power than institutions and governments and countries. And like in the way that the internet has allowed people to join the global community, whether through business or other means, and it has leveled the playing field, Bitcoin does that again in a way that also brings property rights to people that may have never had it. And I do believe that it has the ultimate power in making the world a better place for people. And that's I do think that I'm not alone in that dream and that vision. That's another thing that's so exciting about Bitcoin. It's why I started a company called the Bitcoin Layer. The company was going to have Bitcoin in the name. That much I knew, because this is how I feel. I appreciate you having me out in Australia, man.
Dude, it's a pleasure, man. Honestly, I don't know how many interviews we've done. It's about 6 now.
6, yeah.
About 6 now. Every time it's such a pleasure. And it's just so cool to see you've built this business and you're crushing it. I don't consider you a competitor. I consider you a colleague, someone we work with. I think this rising tide will lift both our ships.
You know, it is a teammate feel. I think a lot of people in Bitcoin feel that way.
Yeah.
That it is a teammate sort of feel. From a mathematical perspective, there are only certain amount of views and listens to go around. But
we can grow that pie together.
None of that, honestly, none of it matters, because we're all trying to add value. I mean, I'm trying to add value and you're trying to add value. When you extract information out of the people that you interview, you know, I always learn a lot. And when I write, teach, speak, and, you know, do interviews and all that, I'm also hoping to add value. People, you know, Bitcoin education, that's what my mission is.
Yeah, well, let's build a bigger pie. That's what I want to do. But no, look, all the best. I wish you all the success. It has been very cool to see you grow a team, and I just want nothing but success for you. And if you're listening, check out the Bitcoin Layer, subscribe, support. Go check out Nik's work, Joe's work as well. Joe's great. Yeah, let's. I think we're going to go and have some dinner. Going to have a couple of beers. We're going to watch some AFL. And then tomorrow we have a live event. So yeah, thanks for coming over, because it's a big journey. So like, I appreciate you coming over to be our guest of honor.
Peace and love.
All right, man.